Why closing a credit card account is a bad idea. Thinking about closing that credit card you never use? If so, your credit may take a hit. So I thought this would be a pretty interesting read. So when you're organizing your personal finances, closing a credit card account that you haven't used for a while may seem like a good idea. That's one less credit account you'll have to worry about, so it might seem easier to simply close the account and stick with other credit cards you use more often. Don't be too quick to close that older credit card though. Having a long-time credit card account on your credit report works in your favor in a few ways that you may not realize. So what happens when I close a credit card account? Closing unused credit cards can feel a lot like spring cleaning your personal finances. After all, the fewer credit accounts you have, the easier it seems to manage and organize your finances. In many cases, an old credit card account may not be much trouble at all, but you just don't like knowing it's out there to possibly be stolen or used for fraudulent transactions. So if a credit card you currently use has a high balance, you may think closing the account will keep you from maxing out the card or getting in debt even deeper. However, closing a credit card is generally a bad idea for these reasons. Your credit utilization rate increases. When it comes to your credit score, your credit utilization ratio makes up about 35% of the FICO score used by credit card companies and lenders to determine credit worthiness. It's easy to calculate your credit utilization ratio, which is the percentage of revolving debt you have in relation to your amount of available credit. For example, if your credit card limits total $10,000 and your credit card debt is $6,000, divide the total balance by the total of your credit limits to find your credit utilization rate. In this scenario, your credit utilization ratio would be 60%, and that's way too high. Personal finance experts recommend keeping your credit utilization rate under 35% to keep the ratio from negatively affecting your credit score. That's where closing a credit card and eliminating the card's accompanying credit limit can lower your credit score. So if your credit card is maxed out and you'll gain more self-control by closing the account, hold off on getting rid of that account. If you close the credit card, that action will lower your amount of available credit, which will raise your credit utilization ratio, lowering your credit score. Instead of closing the credit card, focus on halting new transactions and paying down that card's debt to lower your credit utilization rate and raise your credit score. And older accounts are good for credit history. While you might be tempted to trim the information on your credit report to clean it up, sort of like getting a haircut, that's generally a bad idea. Older accounts without negative payment history are great for your credit score. That's because length of credit history makes up around 15% of your credit score. So older accounts work in your favor, showing creditors that you have experience managing credit card and other debt responsibly. After you don't use a credit card for a long time, you may get a notice from the credit card issuer that you must use the card by a certain date for the account to remain open or for your credit limit to remain the same. If that happens, charge a purchase less than $10 or $20 to the credit card and then pay it off immediately to avoid interest or risk carrying another balance. And when to close a credit card account. Even with all the benefits of keeping a credit card account open, there are a couple of scenarios where closing the account may be a better option. For example, if you're paying a higher annual fee for a card you never use, closing the account can be a good idea. You may want to close a credit card that has you and a spouse as joint card holders if you're going through a divorce. Generally, however, the more credit accounts you have with a lengthy credit history, the better. And here's the thing, right? I agree with some of the stuff that is written in this article, because here's the thing, right? Yes, the longer time frame that you have like a credit account, right, some sort of debt account, the better your credit score is going to be. But also you got to make sure that your payments are always on time. You also got to make certain that the utilization rate, like they said, is very good. But here's the thing. The problem that people need to understand is that if you are bad in terms of debt, if you are maxing out your credit card, if you are constantly never being able to pay off your credit card every single month, you need to stop using that credit card. Period. End of story. And if it's going to take you literally closing the account for you to stop spending money on your credit card, that's something you have to do, right? And you got to be honest with yourself, right? Personal finance is personal. And if you cannot stop spending money on your credit card, if you cannot stop getting yourself into going into debt, then you have to take drastic measures to protect yourself and your loved ones if other people rely on you, right? And that's something that you really got to understand, because debt can be used as a tool for good or bad. The majority of people use it badly, which causes these credit card companies to make a lot of money off of them, right? So that's something to really understand. These credit card companies are not stupid. They are very good at understanding what the majority of the population is going to do and how they are going to use their product. So you got to keep that in mind. Credit card companies are basically going to do whatever they can to get you to go into more debt. They want you to carry a balance because they know that they can make a disgusting amount of money, right? Because think of it like this. They know that they can make a disgusting amount of money on interest if you continuously max out your card. They know that, right? And your balance is going to keep on dramatically increasing constantly over and over and over and over. You can get charged with more fees, right? This is the same reason why banks like doing the whole overdraft fees, because they know that that's a very big moneymaker for them, right? So you just got to keep that in mind. A credit card is not your friend. The credit card companies are not your friend. They are going to do everything they can to make money off of you for the rest of your life, right? They don't want to just make money from you for like a month. They want to make money off of you forever, okay? This is also one of the same reasons as to why they push these whole like credit score things as like such a big deal. But the reality is, a lot of people, if they're simply just living within their means, you're going to have a pretty good credit score. If you have a credit card, if you are using debt in some way, if you just live below your means, you're going to have a good credit score, right? But the only way to really get a perfect credit score is to have a lot of debt that you're paying on every single month, right? I've seen what it takes to actually get a perfect credit score. And you gotta have to be basically paying on time for years a large amount of debt. And you gotta be constantly in debt to have like a perfect credit score. But there's not really any difference between what you can do with a perfect credit score versus someone who has like a 750 credit score or a 720 credit score. There's not really that much of a difference as to what you can do. So just keep that in mind. Credit score is not really as big as you think it is. Like, there's other options available to you, and you got to ask yourself, does it even make sense for me to even have a credit card anymore? If you want to learn how to get a debt, go to 40inbox.com.